Sunil Subramaniam also joins us on the show to talk to us about fundamentals. Sunil, should we have any expectations out of the budget, or do you think it's a bit of a non-event, maybe that usual uptick of 5 to 10% in various allocations, but that's about it?
No. Far from it. I think this is one of the most important budgets of the NDA period because I think it represents a balance that the government has to provide for. I think in the past so far, the unstinted focus on capex has been a defining feature of the budgets, right? And the focus on getting revenues, right? This time around, if you see from the fiscal deficit numbers that have come in, the tax collections that have come in, it's very comfortable from a revenue come tax perspective. So there's no threat to them meeting the fiscal deficit. So that's one thing. So the drive to generate that much more revenues is going to be less. That's one factor. The second aspect is between a continuous focus on capex, right? End of the day, I think today the fact of the matter is that the government's expenditure on capex hasn't filtered down to the common man. So that's why you're seeing mass consumption getting affected, which in turn is affecting a lot of the GDP growth and the rest of it. So the government is got to be sensitive to that. I expect that to come into play. How to divert more of their expenditure, whether capex or revenue, so that it filters down, the trickle down to the bottom is much more effective. I know the government, by doing direct benefit transfer, has stopped the leakage of this, but still, reaching that to the bottom, I think, has not been adequate. That's one of the reasons that the Lok Sabha election results weren't up to speed as far as the government was concerned. They course-corrected in terms of their actual spending patterns to facilitate Haryana and Maharashtra elections. There were a lot of giveaways, Ladli Behan scheme and all of that. So I think that was clearly then a direction to the government that we need to take care of the common man more. And capex is all good, but ultimately, so what they need to find a way now, and especially given the fact that there are two major elections before the next parliamentary election, that's the UP and Bihar. So the government has to now find a way to filter in the populist element within an overall development agenda. They can't give up the development agenda. Why? Because ultimately this government is pro-business, pro-growth, so they will not give up their hand on that. Second is, who's the budget read by? Who's where is important? The more important are the rating agencies, right? The more important are the FIIs, then reaction to the rating agencies' reaction. To that extent, right, they will maintain fiscal discipline. They'll also maintain a focus on capex, right? So this year, I don't know what the revised estimates are going to look like. 11 lakh crore that they budgeted, I doubt if they are going to be able to spend it based on what's happened in the first 6 months. So there will be obviously an amp up on the capex in this month and going on till March, but still they may fall short of the 11. And on the back of that, whether 9 or 10, whatever number they finally come up with the revised estimates, on top of it, they will show growth. But because they didn't spend 11, the growth amount also need not be that much to show up inclination. But the second aspect is they have to find a way to get money down to the poor, the lower middle class, and the middle class, right? And that is going to be the balancing act that the finance minister and team have to do. And I think it's going to be very keenly watched because one is, how much do you allocate to capex and revenue? Because revenue expenditure arguably goes straight to the bottom. The second is, even within the capital expenditure, how do you choose that capex which goes down to job creation, goes down to getting money in the hands of the people, right? So that's one thing why I think that this time it's going to be a very nice budget to read the fine print, understand it, and then react. But there is no question about it that I feel that the populist element, whether right through revenue or through development oriented towards populism, which is what I call developmental populism, is going to be a big challenge and task in front of the government, and they will have to address it. And I think that how do they pull that off without making FIIs stroke rating agencies unhappy? And domestic DIIs and domestic fund managers would not be too unhappy with this shift towards populism, because ultimately for our country, what's the fact? The fact is government has been spending on capital this year, albeit a little less. But the fact is that the GDP growth of the economy cannot really go on an upswing to 7-8% unless private sector capex steps in a big way. And the reason private sector capex is not stepped in is because capacity utilizations have got stuck at the 76-77% levels. If that has to go to 80%, you need mass consumption of mass products, two-wheelers, FMCG, consumer staples, those things which are consumed largely in quantity but not in value terms. The economy's K-shaped recovery is actually translating into the fact that capacity utilizations aren't growing up. So any effort by the government to go towards populism whereby the mass consumption picks up will be a good sign that by the end of the year, you can expect private capex also to pick up, and that will be really then a good growth prospects. So for me, it's not, as you mentioned, right? It's not a Thanda budget. I think it's a budget which hopefully the government will put a lot of thought into it. And based on those takeaways, I think that the future direction of the market will also depend.
Right. Sunil, what's the anticipation then from earnings? Because we're counting down for Reliance's. Can it really pull off any magic, much unlike the previous big boy, HCL Technologies, you think?
It's difficult because it's a conglomerate, right? The retail part is definitely going to be hurting, right? They're just investing in that business. The telecom part should be okay, but I think overall on the refining part, the recent spike in oil prices would be favorable. But over a period of the last 3-4 months, oil has been very steady. So that's not going to be very helpful. So overall, I don't think that this earnings, see, and I'll tell you one more thing. I think the market is also kind of not looking so much at the earnings as much as the guidance that the companies are going to talk about in the earnings season. I think the future is far more important than the past. What has happened in the past, yes, there will be disappointment, there will be positive, surprise, negative, but the market will quickly absorb it. But they will focus on what those companies are talking about, their order books, what they see the way forward, what they're talking about, whether they're going to do expansion plans, brownfield, greenfield. I think that talk, that language, that body language that comes through is far more important for a future direction than the actual quarterly earnings of the October, November, December quarter, which is going to come out.
Okay, point taken. But since we're talking about Reliance, let me take it across to Varun to get the expectations from the street. Hi, Varun.
Well, so we are expecting decent set of results from Reliance Industries, wherein the revenues and EBITDA is expected to grow by around 4.6 to 4.7%. The profit is expected to grow by around 10.7%, and it will reach around 18,337 crore rupees. The margins, if you see, we are expecting a 30 basis point increase in the overall margins. The margins will increase from 16.9% to around 17.2%. The overall results would be supported by the Jio business, wherein we are expecting the ARPUs to show an increase of around 5 to 6%, and the ARPUs will reach above the 200 mark for the first time. We are expecting the ARPUs to reach from 195 to now 206 rupees. Also, for the other business, if you look at the oil business, the oil to chemical business is expected to show weaker performance. The petchem business is expected to show weaker performance. The refining business, although, will show some better performance. If you see in this quarter, on a quarter-on-quarter basis, the Singapore GRMs were up by around 38%. So that would be reflected in the overall GRMs of Reliance Industries as well. When it comes to the retail business is expected to show muted growth. On a year-on-year basis, if you look, the growth would be around, it would be flat or it would be around 1% only. So if you look at the overall results, the results would be decent. It would be supported by the Jio business, wherein the ARPUs would be crossing the 200 levels for the first time.
Okay, that's the take coming in on Reliance Industries. Let's just take stock of how is it that we're shutting shop for the day. And I haven't managed to resurrect a whole lot, while we've definitely come back a little bit flat. But 23,200 thereabouts is where we're currently at. Sunil, just wanted to figure out what your sense is, since we were just talking about earnings, where is it that you anticipate any kind of positive surprise which may not have been baked into the prices in the stocks just yet?
This is not expected. See, I think auto is one where I think overall the numbers in December were fairly decent. So perhaps depending on the discounts at which the prices were sold off those vehicles, right, you could see a positive surprise in those numbers. Otherwise, I'm not very confident that unless the market has actually downgraded the consensus previous quarter, otherwise the numbers are going to be fairly soft relative to the previous quarter. So I think versus expectations, there could be some positive upticks because everybody's kind of downplayed it. But otherwise, I don't think overall the quarter itself as a standalone is going to be a very great set of numbers.
Right. Okay. Shrikant, just wanted to get your sense in on some of these charts. Bajaj Finance, M&M, and then Reliance ahead of the numbers tomorrow.
Like these NBFCs are doing much better if we see the trend of last few days. And in that, if we consider Bajaj Finance, then it is like flat. It is not like uh, uh, above its important like resistance levels, but at the same time, it is very close to its long-term support levels as well as short-term support levels. And from here again, the stock can rebound to the levels of 7,400, 7,500. So for the time being, I'm expecting Bajaj Finance to remain in a range, and currently it is very close to its support level. So at this level, it's a buy. For Mahindra and Mahindra also, we are bullish, and currently the stock is down. But overall, if we see the performance of auto companies, then they are relatively much better than other sectors, and most of this stock again fall into their important support levels. So Mahindra and Mahindra at current level looks very attractive to buy around 2960, 2970 levels with a stop loss close to 2940. And again, we could see the levels of 3000 or 3050 sort of levels in the near term. So if there is any rebound, then I'm expecting Mahindra and Mahindra to do well from the auto space. We also like Tata Motors, but there we are going to see some more consolidation, and maybe it will take some more time. But broadly, Tata Motors and Mahindra both should do well.
Tata Motors, M&M, betting on both those names. But Axis Bank, that's also due to report its numbers, where the NII is expected to reflect the loan growth and PAT is expected to climb 6% on a year-on-year basis. Gaurav is here with his poll.
Well, yes, Axis Bank is going to be the first private sector bank to come out with their third quarter's result. When we talk about system growth, we have already seen the loan growth has slowed down around 11%. Now, for Axis Bank, Street is expecting around 9% loan growth, which will be again slower than the system rate. And the reason being that slow deposit growth. We already know that LDR ratio for Axis Bank is one of the highest in the industry, and that is the reason we may see loan book growth constrained by the deposit growth. Other than that, net interest income is likely to follow the same trend. They are expecting this to increase almost by 9%, while PPOP may grow somewhere around 14% on a year-on-year basis. When we talk about asset quality, slippages may increase because third quarter is usually weak for agri loans, and at the same time, Street is also concerned about some of the retail book loans, and that is the reason slippages may increase. And overall, when we talk about profitability, we may see some impact sequentially, because second quarter was already a quarter where we saw profitability was high for Axis Bank, and that is the reason sequentially Axis Bank's profit can go down. But at the same time, 6% growth is what we are penciling in on a year-on-year basis. On the back of this, now when we talk about net interest margins, we may see contraction of around 6 basis points for Axis Bank in this quarter, and the reason being that the specific loan book growth that we have seen slowing down for banks. Lastly, in terms of asset quality, we are not expecting any kind of a major setback for Axis Bank, but on the back of this, any kind of commentary from the management on the back of asset quality, how the loan book growth is going to be in coming quarters, and how net interest margins will pan out is going to be a key thing to watch out for. Overall, we are not expecting any kind of setback, but in terms of number, a little bit of slowdown is what Street is penciling in for Axis Bank for third quarter.
Bit of a slowdown, and the slowdown is visible in the stock price as well, because that one is down and out. But Infosys also comes out with its earnings, and after robust H1, the expectation is there is going to be a bit of a moderation there as well. We are expecting a 0.6% growth when it comes to the rupee revenue. The dollar revenue is expected to decline by 0.3% because there would be a constant currency or rather cross currency headwind to the tune of 70 to 90 basis point. So overall, a bit of a tepid set. There is no major headwind or tailwind with respect to the margins. So we are expecting the number to be closer to 21.3%. Tailwinds are expected steady, but of course the key would be the guidance upgrade. The street is expecting that the guidance will be upgraded to maybe 4 to 4.5% or maybe 4 to 4.75%. So that's something to really watch out for. For LTI Mindtree as well, there's going to be a slower growth, just 1.5% in terms of constant currency. But the bigger thing to watch out there is going to be the margin impact, because we're expecting margins to come at multi-quarter lows at maybe 13.6%, because there's going to be a wage hike impact to the tune of 190 to 200 basis points. So the operating leverage with respect to top line growth is missing, plus the hit of furloughs, plus seasonality. weakness in high tech and wage hikes, all of that will mean that the profit on a sequential basis might decline a bit. But Sunil, that begs the question, what to do with IT, because TCS saw a 6% gain post earnings, HCL Tech saw a drop of 9-10% post its earnings. The commentary from both were quite similar in the fashion that both were non-committal about growth. Both were saying it's headed in the right direction and that it will need a couple more quarters to call it out. What do you make of the IT pack right now?
I think IT pack has moved into a more of a safety zone compared to the growth zone that it was ever since the Trump news came. IT has been rallying very strongly, right? So I think that's partly the depreciation, the dollar strengthening effect, and the fact that American businesses are going to be supported by the Trump administration, which means greater order books, right? So those two macro numbers were the ones which drove IT up. Now I think that, according to me, the dollar depreciation part is done and dusted, because dollar appreciation part, sorry, because I don't think Mr. Trump, when he comes to power, will want a stronger dollar. If he wants to make America great again and boost American exports, the dollar cannot be stronger. The dollar has to be weaker. So he's likely to favor a weaker dollar, which is to some extent then not very positive for the IT, but that's okay, because ultimately even those gains generally tend to get competed away by other competitors as well as by the big buyers in the US. So the growth aspect, though, I think will remain. And I think for that reason, future growth, regardless of what the commentary these people say, what's happening in America, right, is that corporate America is rebounding. You're seeing those numbers come through strongly. And I think the advent of AI in a big way in almost every industry will need IT consulting support. And I think Indian companies are up to speed on that. So I think the orders will be good. The growth outlook is good. But like I said, because the currency aspect has been a bit overdone, I feel that IT has now moved into a safer zone. It's definitely a must hold in a portfolio. But I would say the growth, the rapid growth in the stock prices and everything, those I think you shouldn't expect to repeat again. I think stability, which is the traditional place where IT is, right? It's the safety pack. And when the FIs return after all this Trump Jamela ends, right? I think they will come and pick IT. So IT will get buying support from overseas. So I think it should remain there as a steady part of the portfolio from a safety angle.
Okay, that's that on what to expect from technology. Idea, BSE, Paytm, Nykaa, HDFC, AMC. Sunil, clearly the market's got a lot of fancy to the capital market theme. And then, of course, some of these aggregator plays as well, be it a Nykaa or a Zomato. Nykaa, in fact, has moved up after quite a bit. I don't know whether this buying is going to sustain or not, but definitely that's the case for Zomato. That 220 low that we had day before got lapped up very soon.
I would say are the new India, right? Everybody talks about the K-shaped recovery in consumption, but you got to realize that the K-shape is actually happening to the incomes. And the second is the demographic change that India is going through as we're getting to a much younger population. So these two factors, right? When the K-shape sees through in savings, that's why the capital markets, you see the SIP going on month higher despite the markets being so volatile. You see mutual funds sitting 2 lakh crores on cash. That means they've got enough and more money coming into their counters. Now this comes through distribution houses. The obviously capital market infrastructure like BSE, NSE will benefit. So I'm very bullish on the overall new age, new India kind of a thing, which I may call this. That is, the rise in the per capita income is getting spread. It's actually widening the disparity between the bottom and the top. So the rich are getting richer in a way. And I think if you see overall at the $2,800 per capita, I would say the spread is we have a lot of people at $4,000 and a lot of people at $1,500. So that impact, that's why quick commerce and all of these are also getting to pay, because the younger, willing to take technology on, willing to sit and order. So I think this change in the buying pattern, the change in the savings pattern, you have hit the nail on the head that both these are effectively reflecting the new India. And I'm very bullish that whatever growth prospects we are expecting, they would actually outperform over the medium term. Short term, there will be volatility, but these are definitely strong growth picks for me. So in the BFSI, the savings and investment side of the pie, and within the e-commerce, the quick commerce, and those kind of aspects are obviously the ones that, and fashion and everything are obviously a part of that.
Point taken. In the meantime, Shrikant, wanted your take regarding some of these other buzzers. Take a look at Thermax, up 7.5%. Keynes Technologies, up 6%. Dixon Tech, of course, got that initiation from MK, is also perked up around 4%. Indian Hotels is up 4%. Any of these actually the plays from Industrials Pack, Keynes, Dixon, Thermax that you're looking at?
From this particular space, we like Keynes Technology. Other stocks, I'm seeing they are correcting from the highs, and there is some bearish technical formation on daily as well as weekly basis. So Dixon number, I think there we should be cautious in terms of taking any specific trading call. But if there is any specific view of taking short-term bullish view on the stock, then Keynes look really good. It is trading around some at around 6575 levels, and from here again the stock can move towards the next levels of maybe 7000, 7200. And even if we consider the long-term pattern of the stock, then it is like still in the control. If there is any correction, then again we should look for taking some position. I think now 6300 is going to act as very good support for the stock. From the other maybe tourism or travel stocks, we like Indian hotels, and there also we saw very substantial up move in the last 2 days. But in case if there is any correction, then close to 790, 795 levels, it looks good to buy and hold. I'm expecting this stock to again surpass its previous high of 850 or 880 sort of levels. So it's a buy at current levels, more on dips. So Indian hotels and Keynes Technology, certainly we should look for taking bets with a medium W.
Right, okay. Those are some of interesting stock ideas coming our way. Naresh, what's your observation about, what kind of trend one is seeing today? Because other than some of those extremely beaten down names like a Paytm, Idea, Nykaa, etc., I don't know what definitive trend to really pick up in the market today.
So the main trend is the fact that we've stopped seeing follow-up price action in terms of selling in the broader markets as well as on the indices. So that tells you some bit of base formation is happening over here. And overall, the breadth has started improving in the last 2 sessions. So now we look out for a follow-up buying action. If that happens, then there could be a lot more opportunities. But the broader markets have corrected much more than the indices. So that pain is much higher, and that's the reason there could be stock-specific opportunities.
Okay, point taken. So that's the top recommendations coming in right now. But Shrikant, any BTSC trades from your end?
Yeah, I think at this levels, few these auto companies, I think they should do well in the near term. That's the view. We like Mahindra and Mahindra, on which already we have given call, but we also like Eicher Motors, which is currently trading at 5080, 5090 levels. There I am expecting stock to move towards the levels of at least 5200, 5250. Today also, if we see the trend, then it is gradually moving upwards. So we can keep stop loss somewhere close to 5040 for the same, for taking any short-term call on Eicher Motors.
The trend on some of these buzzing stocks. In the meantime, M&M, of course, is cracking today. That's down about 3% odd. Bajaj Finance lower, Axis lower. That's pretty much the case with an ICICI Bank as well. A little bit tempered right now, and so is HDFC Bank. But Sunil, what is your sense on whether or not, whenever the market does rebound meaningfully, whether it's going to be led by financials? And within financials, again, what segment do you think is going to perform?
I think that, yes, I think that the rally will be led by the financials. And but then I would say that would be a week after the budget, because market will need time to digest the budget, and there's the RBI policy on the 6th of February, right? So I think financials will, people's allocation will wait for the RBI policy, because this rate cut scenario is still 50-50, right? It's going to come, not going to come. So there's going to be a lot of noise around that. So I would say that the true rebound rally, and the rally is going to happen soon, because there's 2 lakh crore of cash sitting on mutual fund AUM today, right? And that money is waiting on the sidelines for all of this noise and news to go through. So post February 7th, I would see that. And I do expect BFSI, because whether there's rate cut or not, right? I think that overall the budget will give an impetus to the consumption space, is what my read is. And I think that financing of that is obviously a key element that needs to support that. But the fastest growing segment is what we just referred to a couple of minutes ago. It's the savings and investment piece of the banking and financial services industry. It's the stock market infrastructure, the wealth managers, the AMCs, the insurance companies, the distributors, brokers. I think that's the pack which will really rally, because that's the one sustaining story, is this continuous interest by the domestic investors in staying invested in the market through mutual funds and insurance. I think that's not got shaken. Consumption has got shaken. Capex has been here and there. The one continuing story around our country, if you see over the last year, is been this savings into the stock market. And I think that's a story which will get a boost, and that's what I expect will lead the rally in the post-budget time frame.
Great to have you on the show.